Hi, everybody. Thanks so much for joining today. We will begin shortly after giving everybody just a few more minutes to trickle in. Mhm. All right. So I think we can get things started. Again, hi, everybody. Thanks so much for joining NFI Solutions today for this presentation. We're super excited to get started. We are joined today by Scott Scheuren. Scott has been in the insurance industry for over 2 decades. He is a certified 7, 31, 63, and 65 license holder. Just a few house cleaning items before we begin. This webinar will be recorded. If you would like a copy of the webinar after this presentation ends, please send an email request to marketing@nfisolutions.com or give us a call at 952-887-1239. And this information is posted in our chat, so you can look over there. There will be a Q&A session at the end of the presentation. If you have any questions, feel free to pop them into the Q&A chat, and we will answer them. And I will also be looking into the chat Q&A periodically. And if you can, everybody hear us okay? You can just pop a message into the chat. Just we want to make sure that everybody can hear Scott and I okay. Or you can react to the webinar if that's easier for you. Okay. All right. Okay, so take it away, Scott.
All right. Thank you, Selena. Well, good morning, everyone. Thanks for taking time out of your day to join me for today's call. My name is Scott Scheuren. I think you'll like what we have to talk about today. I have 24 years of financial services experience and work for some larger brokerage houses in Morgan Stanley and JP Morgan Chase. After the financial crisis in 2009, I started S&W Financial Services, and I've been running that ever since. As Selena alluded to, I have a Series 7, 31, 63, 65 licenses, which all that means is I can pretty much do any kind of investment. I also have my life and health licenses. So what we're going to talk about today is a way to put more money in your pocket and help your clients out or prospects. We're going to create an income stream for your clients to self-fund by only using the interest and preserving the principal to fund life insurance policy. As many of you know, premium financing has become increasingly hard or at least almost impossible to do. The Federal Reserve has raised interest rates the fastest in history to combat inflation, and now borrowing rates are high and even going higher. Illustrating these high rates on a life ledger doesn't look good. Not only have high rates been a problem, but now higher collateralization requirements are an issue. So credit standards and terms are continuing to tighten sharply. The good news is that we have a solution. It doesn't require going through a bank for a loan or have any collateral requirement. There is no underwriting process. The premium market goes after the $3 million net worth and higher client. With this, we can go after the lower net worth client and thus be able to go after a larger market. And we can still do those larger ones as well. So what are we doing here? We're using a securities product called an income structured note to fund a life policy, usually a 10-pay index universal life policy, by using the interest, or what's called a coupon, to fund the policy for 10 years. After the 10 years, you have a fully funded life policy in your cost basis, and the structured notes still paying the interest. A structured note is like a bond where you have a maturity date, an issue date, and most of the ones that we do are 5-year maturities. Structured notes used to be only offered to institutional investors and ultra wealthy individuals, but in more recent times, they were brought to the smaller investor. Me personally, I've been selling these to clients for the last 12 years, and I've probably done close to about 200 different ones. Structured notes can be bought through various third-party outlets, but my broker-dealer also creates these. And what we do is we shop it around to various investment banks like Citigroup, Morgan Stanley, Bank of America, just to name a few, and even some overseas investment banks. And this gives us a way to shop it around and get the best terms and rates for our clients than these third-party outlets. The current rates that we're seeing recently have been in the 12 to 16% range. The client would deposit money into the brokerage, and depending on the size, we'd usually buy 3 to 6 structured notes and ladder that over 3 to 6 months, usually one a month. To determine how much life premium we can generate from the structured notes, I use a figure of 10%. So if a client puts in $1 million into the structured notes, we can safely generate $100,000 a life premium each year. If a client puts in $500,000 into structured notes, 10% of that is $50,000 a year of premium. Structured notes can be held within non-qualified accounts. It can be held in IRAs, various types of trust, and business accounts. I've worked with many agents across the country using this strategy, and it's worked out really well for them. What we normally do is a Zoom call with the client and the agent. And for bigger cases, I've flown in to meet the agent and the client. So for instance, about a month ago, I had an agent in Alabama that had a client in Florida. And so I flew down to Florida and met the client and the agent there and had that appointment. So let's go through an example. So this is an example of a structured note. So as you can see here, we have a issuer, we have a annual rate of return, and in all these structured notes, the interest or the coupon is paid out quarterly. So what it does, it looks at usually 3 stocks or 3 indexes. And the stocks or indexes, or I should say the stocks, are usually going to be in really conservative industries, like telecom, banks, the larger banks, tobacco and oil. So, and if we look at indexes, it could look like something like the S&P 500, the Russell 2000, and then maybe they'll throw in like a foreign index like the Eurostoxx 50, something like that. So what this does is when it gets issued, each one of the 3 stocks will have a closing price. So for simplicity's sake, let's just say that all 3 of the stocks were at 100 at the issue date. So what they're going to do is calculate a value that's 30% less of the issue date closing price, which would be 70, and that's considered the coupon barrier. So every 3 months on a specific date, they're going to look to see if each one of these stocks is at or above $70 in this case. And if it is, it's going to pay out 1/4 of that 12% interest. And it's going to keep doing that until maturity or the issuer matures it early. One thing to note on the issuer maturing it early, that happens about 70% of the time after doing almost 200 of these over the last 12 years. So when that happens, 100% of the client's principal goes into a money market. And when that happens, we're just going to put that client right back into another one. And because they're issued, most of these that we do are issued through my broker dealer, we can quickly get into another one, usually in about a week or so. So the only way that you can lose any principal if you don't sell it, it does have a secondary value, so it'll fluctuate up and down in value, right? But the only way you can lose any principal is if it makes it to final maturity. And like I said, most of the time it doesn't. But one of the stocks on that specific date would have to be down more than 40% only on maturity. So let's say that we go through a COVID-like activity, financial crisis activity, and the stock is down, say, 45% prior to maturity. The client probably wouldn't get paid out their quarterly coupon, but they wouldn't lose any principal either. So if it's down 45% and then matures down 39%, and let's say the others are, above that 40% down, the client would still get back all their principal. So, it's, of the couple hundred that we've done, not a single person's lost any money at maturity. So, and what we normally do is the coupon barrier percentage here. If we're looking at something that's just a little bit more volatile, say like oil, that can move up and down, the oil stocks can move up and down a little bit more, we're going to set that coupon barrier at 40 or 50%. And then the downside threshold or that principal barrier, we're also going to set at 50%. So the last thing we want to do is lose any client's principal when we do these. And that's why we'll increase that principal barrier. So here's actually a structured note that we did a few months ago. So the issuer is UBS. It pays 15% annual interest, and it looks at 3 large bank stocks, Citigroup, JP Morgan, and Wells Fargo. So at the close on 2/15, Citigroup had a closing price of 47.58. And then JP Morgan and Wells Fargo also had closing prices. So they're just going to calculate a value that's 30% less of that. And on 5/15, 8/15, 11/15, and 2/15 of each year, they're going to look to see if each one of those stocks is at or above its coupon barrier. And if it is, it pays that 1/4 of that 15%. And that goes right into a very liquid money market account that's easily accessible to pay for those life insurance premiums. So, why income structure notes? So, there's other types of things that you can use to generate revenue, to maybe fund these policies, but you're going to find it hard to get the rates that we get, and at very little risk to your principal. So, just a summary here. So, the underlying stocks or index can lose up to 30%. And it would still pay out that coupon and have that payable to that money market. Again, the only chance to lose any principal is only at final maturity, and one of the stocks would have to be down 40 or 50%. So at these current rates right now for these structured notes, the stock ones are at 12 to 16%, and the ones that look at 3 indexes are going to be like 9 to 13%. So basically, you're outperforming the S&P 500 And, like we had said, you can still lose up to 30% of that value of those underlying stocks and still get paid the interest, where if you're in the market directly, you're going to take that downside. So there is a secondary market for these structured notes. So you can sell them at any time. And I've had clients that have done that for, as an emergency came up where they needed their money for something, we could sell off a portion of that structured note or all of it. So you do have that liquidity factor. So that is very nice. And these are a contractual obligation from the issuer, so they cannot change the terms. So for instance, in that UBS structured note that I showed, that 15% yearly interest cannot change. And the rate that it pays out is your contribution amount or your principal amount times that coupon rate. So let's look at a case study here. So this client had $4 million that they wanted to use this strategy with. So what we're going to do is we're going to ladder that about $4 million into 6 different structured notes into different months. So that further reduces the risk, and it also evens out the payments. So since these pay out every 3 months, eventually you're going to have 2 coupons that pay out each month, laddering it into 6 different months. So for illustration purposes, we're going to use a coupon rate of return of 12%, which is pretty conservative in today's market. And if we start this in April, we'll be into all our positions in September. And what we're going to do for this particular client is, because they wanted to start the structured notes the same time as the life insurance policy, we're going to keep 5 months of premium to fund that life insurance policy, just to have that accumulation of the structured notes start up, because it takes 3 months to start, and we want to have a few months of deposits before we start using the structured note income to pay for those premiums. So in this case, the client's going to use $166,000 in probably a checking account. And we can see how this all fits together. So if we start this strategy in April, we can see that the first coupon would be in July. And at 12%, with the amount that went in and paid out quarterly, the first coupon amount is going to be $19,170. And in August, the second note is going to pay out. In September, the third one. And then you see after that point in time, if every single structured note is above its coupon barrier, we can see that amount doubles because you have 2 of them paying out. So you can see that pattern going through all the way here. And the coupons get paid into a money market brokerage account. So it creates a very liquid position. The monthly premium for this particular client was $33,000 a month approximately. And you can see here that we're just keeping those 5 months of payments within a client's account, say like a checking account. So after these 5 months run out, we're simply going to take the money from the brokerage account, the $33,000 approximately of premium, and send that electronically right into the same bank account that the client has taken it out. So it kind of is a seamless process there. So we have enough fluff in here of excess structured note payments to see that money market brokerage account builds up. And the reason why we do that, and the reason why we use 10% instead of say 12 or 13%, is that we want to keep enough in there just in case 1 or 2 of these structured notes don't pay out its coupon. We'll have enough in there to still pay for that $33,000 premium. So here's the life insurance ledger. And this particular person was 46 years old. And we can see that the 33,000 times 12 is about 400,000 of premium. So they're going to fund this, pretty much fully fund it, using the structured notes for 10 years. And at the end of those 10 years, you have a fully funded policy, and you still have the structured notes of approximately $4 million still paying interest. And this policy started, if a person passed away, and I'm sure you guys are very familiar with this side of things, but if a person passed away right away, they would have a death benefit of $13 million. And in the 11th year here, the client could take out tax-free distributions as a loan of $422,000. And not only that, but they still have those structured notes of about $4 million, still paying $460,000 of income a year to them. So if you have 460,000 plus the 422, you're approaching almost $900,000 of income each year, and almost half of that is tax-free to the client. So that is pretty cool. And let's say the client lives to age 80 years old. Okay, so they would have taken, if they would have taken distributions out in the 11th year, they would have taken $10.5 million of tax-free income, plus the $460,000 of the structured notes. And when that person passes away, they pass on a death benefit of $3.2 million using the current scenario. And they still have that $4 million that they can pass on to their beneficiaries. So if you add that all up, that's, what is that? That's almost about $18 million of a $4 million starting investment that they either use themselves or are going to pass on to their beneficiaries. So you can kind of see the illustration here. So if they live longer, you can see, if they lived to 100, they would have taken out $19 million in distributions and still passed on a death benefit using this current scenario of $7.4 million, plus the structured notes. All right. So that's how that all works with the structured notes and how it funds a life insurance policy. So now I wanted to talk about some higher net worth individuals and what they're looking for. And I'm sure you guys are well aware of this, but maybe some of you aren't. So higher net worth individuals face unique financial challenges and goals, such as preserving their wealth, minimizing taxes, and ensuring a smooth transfer of assets to future generations. One overlooked but essential tool for addressing these objectives is life insurance. So life insurance plays a critical role in wealth preservation, tax efficiency, estate planning. So, if we look at liquidity, and this is pretty obvious to a person that sold life insurance policy, but the beneficiary gets immediate liquidity through the death benefit, which can be used for paying estate taxes, legal fees, and other expenses associated with settling an estate. Obviously there's a tax-free death benefit associated with that. That's paid to the beneficiaries. There is flexibility, so life insurance policies can be structured to meet the unique needs of high net worth individuals and their families. This may include setting up trust or using other estate planning tools to protect assets, provide income to beneficiaries, and ensure that wealth is transferred according to the policyholder's wishes. There's also the wealth preservation aspect of it, where the person can preserve their wealth for future generations by providing a guaranteed death benefit, which can be used to replace lost income, cover estate taxes, or fulfill their other financial needs. Life insurance for a lot of these high net worth individuals, multi-generational planning can be used to establish financial legacy for multiple generations. By setting up trusts or other estate planning structures, life insurance proceeds can be used to provide ongoing financial support to children, grandchildren. And then interesting thing too that I thought about was equalizing inheritances. In some cases, it can be used, with multiple beneficiaries of different financial needs and liabilities. So life insurance can be used to equalize inheritances, ensuring that each beneficiary receives a fair share of their estate. One thing I think that high net worth individuals, might be good for marketing purposes is a ILIT, irrevocable life insurance trust. So, and that's basically, I don't know if you guys are familiar with that, but it's a legal entity designed to hold and manage a life insurance policy, primarily aiming to keep life insurance proceeds out of the policyholder's taxable estate. This provides additional tax efficiency and control over asset distribution to the beneficiary. When a life insurance policy is owned by the individual, the death benefit might be included in their taxable estate, potentially subject to federal estate taxes. By transferring ownership to the ILIT, the policyholder removes the death benefit from their taxable estate and thus reducing overall estate tax liability and enabling beneficiaries to receive the full death benefit without the estate tax reductions. So that's kind of cool. ILITs offer control over asset distribution. As the trust document outlines the terms and conditions for managing and distributing the life insurance proceeds. The policyholder or the grantor appoints a trustee to manage the ILIT and specifies the terms for distributing the trust assets to the beneficiaries, ensuring wealth is passed according to the grantor's wishes. Assets within an ILIT are generally protected from the policyholder's creditors, preserving life insurance proceeds for intended beneficiaries. So the contributions to the ILIT for policy premiums are considered taxable gifts, but the grantor can utilize their annual gift tax exclusion to minimize or eliminate gift tax liability. ILITs can also be structured to benefit multiple generations while minimizing or avoiding the generation skipping transfer tax. As ILITs are irrevocable and cannot be altered or revoked by the grantor, careful planning and consideration are essential when establishing one. Another thing that high net worth individuals are looking for are, especially business owners, I guess only business owners, is deferred compensation. So deferred compensation refers to any and all compensation plans that allow you to postpone a portion of your income to the future, reducing your current taxable income. This includes both qualified and non-qualified deferred comp plans. We'll focus on non-qualified. These plans have been dubbed golden handcuffs because they're often used as a retention tool for a key talent or highly compensated employees. Since non-qualified deferred comp plans aren't subject to ERISA standards, there's no cap on the contribution amount. Traditional retirement plans and accounts can be insufficient for helping highly compensated employees adequately save for retirement. A supplemental non-qualified deferred plan can be an attractive way to generate additional retirement savings and income. So another thing that I've helped clients out, and I'm sure many of you have too, is especially on the life insurance side, is buy-sell agreements and key person insurance. So buy-sell agreements and key person insurance are essential components of business planning, particularly for high net worth individuals who own businesses or have significant ownership interests. Life insurance can play a critical role in addressing these needs by providing the necessary funds to ensure business continuity and minimize the financial impact of losing a key employee or business partner. So buy-sell agreements are a legally binding contract between business partners that outline the terms and conditions under which a partner's ownership interest can be bought out upon a specific triggering event, such as death, disability, or retirement. Life insurance can be used to fund buy-sell agreements, ensuring that the surviving partner have immediate liquidity to purchase the deceased partner's ownership interest. This arrangement helps maintain business continuity and prevents the need for external financing or forced sale of business assets. So there's basically two kinds of buy-sell agreements. There's the cross-purchase agreement, and in general, it's where the partner buys life insurance on each other and use the death benefit to purchase the deceased partner's ownership interest. And then the other type is entity purchase agreements, where they use the business life insurance to buy the deceased partner's ownership interest and distribute it among the surviving partners. All right, so charitable giving with life insurance. So a lot of high net worth clients, don't know how to give to charities, and one effective way to do that is through life insurance. So, the most simple way is just naming the beneficiary on the life insurance policy. Another way is through a charitable remainder trust. And that's basically an irrevocable trust that provides income to the grantor or other beneficiaries for a specified term of their lifetime, with the remaining assets to be designated to a charity upon the trust termination. So people can use life insurance to replace the wealth transferred to the CRT, the Charitable Remainder Trust, ensuring that the heirs receive an inheritance while still supporting their philanthropical goals. Another way is through charitable lead trust. Charitable lead trust is an irrevocable trust that provides income to a designated charity for a specified term, with the remaining assets passing to the grantor's heirs upon the trust termination. The fourth way is through endowment policies, where a person can purchase an endowment life insurance policy and name a charity as the beneficiary. The endowment policy combines the life insurance coverage with the kind of like a savings component, which accumulates cash value over time. Upon the policy's maturity or the policyholder's death, the charity would receive the accumulated cash value or the death benefit, providing a substantial financial contribution. And then the last way is through wealth replacement strategies. A person could use life insurance in combination with the charitable giving strategies, such as donating appreciated assets or setting up donor advised funds. By purchasing a life policy to replace the donated wealth, the person can ensure that the heirs receive inheritance while still supporting their philanthropical goals. So that pretty much concludes my presentation. So the next process, so if you guys have like a prospect or a client that's looking to use these structured notes to fund a life policy, or any other things that I may have mentioned, we do have a questionnaire that your marketer can provide to you, and that you can get that information from the client or prospect. So once we have that information, what we would do is set up an appointment with the marketer and myself, and kind of go through what we can do for that client. And then obviously once that's all set up, we'll usually set up a Zoom call with the client and the agent. And then for larger cases, just say like 1 million and over investable assets, I'd be willing to meet with you and your client in person. So that concludes the meeting, at least my portion. And I guess we're going to take some questions if you guys have any.
Yes. And you can put those questions, if you have any, into the chat, the Q&A chat. I can give about 20 seconds or so. In the meantime, I do have some questions already for you, Scott. First one is, if a person only has $100,000, can they use structured notes to fund a life policy?
Oh, that's a good question. Yeah, you still could. At $100,000, we could get a policy funding at $10,000 a year. Particularly works nicer for younger individuals because, especially if they're looking for income, because that provides more time for that cash value to build. So, yeah, absolutely, we could do that with $100,000.
Awesome. And then another one here, does the agent get paid on the life insurance?
Yes, the agent gets paid 100% on the life insurance side.
All right. And then just a few more questions here. Can clients use qualified money into this?
Yes, you can use qualified money. The distributions would be taxable, but if you think about it, as those qualified monies grow, it becomes a bigger tax burden. So a lot of people will peel off money out of their qualified accounts and fund something that's tax free, like the life insurance. Yes, absolutely.
All right. And does the client compensate you for your services?
There is no cost for this. So I get compensated directly from the companies I place the structured notes with. So
Mm-hmm.
in that one illustration that showed UBS being the issuer, they would pay me, and there would be no fees to the client.
Okay. And are there any age constraints?
For the structured notes, there are no age constraints. For the life insurance, I guess you would have to, look at that kind of on a one-on-one basis. As a person gets a little bit older, it's harder to get a permanent life insurance policy. But yeah,
Mm-hmm.
for the structured notes, there is no age constraint.
Okay. And it looks like there's two more questions. Do you only do 10 pays?
We find that 10 pay usually works out really good for our clients, but we can do it other ways as well. So, all
Mm-hmm.
we're doing is just using the structured notes as a funding mechanism for the life insurance. So we could do it, over a lifetime or even a shorter time.
Gotcha. And I believe you might have answered this already, but just in case, can business structures be used with this program?
Yes, absolutely. Works out really good for business entities. We can pretty much put the structured notes in any type of an account, whether it be business or non-business or charity.
All right, awesome. And that is all the questions that I see as of right now. I'll just give it like another minute or so to see if anybody else has additional questions. Again, you can feel free to put those in the chat, and I'll read them off to Scott. Give it a minute. Okay. Right. I'm not seeing anything pop up yet. But again, if you want to get connected with Scott, just give NFI Solutions a call. Our number is posted into the chat, 952-887-1239. And I just want to reiterate that a copy of the webinar will be available. Just shoot us an email at marketing@nfisolutions.com, or again, just give us a call. Nothing's popping up. I want to thank you all for taking the time out of your day to join us for this webinar. And feel free to reach out to NFI Solutions with any questions or concerns. And we look forward to working with you and getting you on the path to no stress success. Thank you.
Thanks for your time, guys.
All right.